Hello, welcome back to the Scarabelli Way. Today we're going to talk about an IUL, an Index Universal Life Policy. How does money compound in it? Is my money protected? What do I have in advantages in having an IUL? All those questions I'm going to answer in just a little bit, but please don't forget to like, comment, and subscribe to our channel because it helps us out a lot. Alrighty, dighty. So this is what IUL stands for. It stands for Index Universal Life. This is a life insurance policy where you can accumulate money over time, and your money is protected in a lot of different ways. So let's go to it. Let's say that Bob has some extra money that he wants to put into an IUL policy. It could be $100 a month, it could be $500 a month, or it could be $5,000 a month. Let's say, for example, Bob puts in $500 a month within his policy. I'm going to represent this policy as a safe because, as I said before, it is a very safe vehicle where you can put your money. Okay? By putting that money every single month in this policy, let's say that Bob has a $500,000 life insurance protection. But a lot of companies don't offer just life insurance. They offer life insurance with living benefits. So right here, we're going to portray his financial foundation. Okay. If Bob ends up having a terminal illness where he goes to the doctor and the doctor says he only has up to 24 months in life expectancy, he can get up to 90% of this amount. So it doesn't matter if Bob put $500 or $5,000, if he did it for 2 or 3 or 4 years, he's going to be offered up to 90% depending on his condition and how long he's actually been putting money into this policy. Okay, he could be offered 300,000, he could be offered 400,000, and it's up to him if he wants to accelerate that full amount or if he wants to use 100 or 200,000 to pay for treatment. Now, why is this coverage important? It's important because the main cause for financial bankruptcy in the United States is medically related. So people can't continue working and they can't produce more income and they have to tap into their savings. And sometimes they tap into all their savings. So this is important to have a strong financial foundation. Now, the second step here would be if Bob were to have a critical illness or critical injury. Okay, so I'll put critical illness or injury. In this case, he can accelerate up to 80% of what his coverage is. So if he has a $500,000 coverage, he can accelerate up to $400,000 depending on how severe that illness or that injury is. Okay, so right here, if he's been putting money just for a few months or a few years, he can still use up to $400,000 from his policy. The third case would be if Bob had a chronic illness and he was unable to, so illness with 2 L's, right? And he was unable to do 2 of the 6 main activities of daily living, which are bathing, walking, which is transferring, continence, doing his personal hygiene, eating, or dressing. If he needs help to do 2 of these 6 daily activities, then he can use that 80%, but he would be paid 20% a month up to 50 months. Why up to 50 months? Because if he uses 2% 50 times, that comes out to 100%. If he becomes permanently disabled, then a lot of times he will get that amount up front. Okay. And also, if he passes away, 100% of his money goes to his family. Okay. It's important to say that this money is tax free. All right. So we've been talking about bad things up until now, right? we hope that nothing happens to Bob during the time that he's putting money into this policy. So let's say he's putting money for 20, 30, 40 years. What's going to happen with that money? It's important to state that a percentage is going towards his financial foundation. Usually, for the first 10 years of the policy, it's usually about 30% of what he's putting in there, 30 to 35%. But the rest of the money is going into this safe right here that is compounding over time. So we're getting interest on top of this money. We call this an indexed universal life policy because the money is actually indexed to one of our market indexes, right? So if we choose the S&P 500, Credit Suisse, if we choose US Paysetter, whatever index we choose, our money is going to follow that according to the market. Now, an important thing here to say in this second phase, which is the phase of accumulation, is that we have a 0% floor. So if the market falls 10%, we don't lose any money with the market. If it goes down by 20%, we don't lose any money with the market as well. So let me show you an example. So example number one, we have the index plan, and example number two, we have, US Paysetter. Okay. Let's say the US Paysetter went up 10% on the first year. So let's say we have $10,000 in this plan, okay, in our index account. That means that we're also going to go up by 10%. Instead of having $10,000 in year two, we're going to have $11,000. So Bob here is super happy because he just made $1,000 in interest. In the next year, let's say that the US Paysetter falls 20%, right? Like the market in 2022, S&P 500 went down, I think that's 22%. In this case, Bob does not lose any money. He stays in that $11,000 mark, so he is doing okay. He's not sad. This would be a sad face. Let me do a better face. He's all right. He's not happy, but he's not sad because he's not losing money. If this were to happen to Bob here, Bob would be desperate because the market's falling, right? If he has $11,000 and in year two it falls 20%, he would go to $8,800, right? Wouldn't be a good situation for Bob. Now, if he continues with this money in his index account the next year, let's say it goes up 6%, he will get 6% on top of the $11,000 he already had in there. Right? So if we get 11,000 times 1.06, that would give us $11,660. Okay? Thereon and therefore. So this means that our index account grow like this. They don't grow like this, right? Like the stock market. Sometimes we're up, sometimes we're down. We don't know how much money we're going to have in year 5, year 6, year 10. Okay? What we do know in the index accounts is that we are not going to have less money that is actually going into accumulation. All right. That's where a strategy called infinite banking jumps in, but we're going to talk more about that later. Okay, so let's go back. So we went through accumulation. So we have money that's going into that pool, and we're getting indexed year by year. We're getting interest on that money. Okay. Let's say now that when we come to our retirement age, we're going to have a distribution. So we're going to get that money in the future as lifetime income, right? If nothing happened to Bob during all this time, remember that he has all these protections. So if something were to happen to him, he could get up to $450,000 while he's living, or his family can get up to $100,000. If nothing were to happen to Bob, that money would create a large sum in the future. And if he uses that money, he can use that money as lifetime income. And if he uses the right strategies, this money could potentially be tax-free. Now, when I say tax-free, it's tax-free, which means no income taxes, and no capital gains taxes. Now, as you may know, income taxes are at about 28%. That's the average, that's the national average. And capital gains taxes could be anywhere from 15% to 20% in the long term. So this could correspond a big chunk of money whenever he gets a lifetime income in the future. Okay? Now, it's important to state here that this is only tax-free if he takes this money out as loans, right? So if he has, let's say, $500,000 in the future. So if he has $500,000 in the future and he takes out $50,000 a year, he can take that out, he can withdraw that money, but he's going to pay income taxes on that money. It's going to be tax deferred in that case. But if he takes them out as loans, then he pays no taxes on that money. What will happen is his death benefit is also going to decrease over time. That's a strategy where you can make this potentially tax-free. That's what we do while we're setting this up for our clients. Okay? Now, I told you guys that we would talk a little bit about infinite banking. What is infinite banking? Infinite banking is pretty much whenever, let's say Bob is, he sees that the market's going down and people are kind of desperate, selling their real estate properties, selling, their stocks and everything, and he's zeroed out at 0%. What he can do is borrow money, from his account, or what he will do is borrow money from the insurance carrier at, let's say, 4% a year, right? And he's actually making on average 6 to 10% a year on that money. So he's leveraging that money. Okay, so let's do an example. Let's say he has here $100,000 in cash value. After 10 years, he's been putting money in there, right? He has the option. Let's say he wants to put $30,000 in a down payment. Okay, he has the option to withdraw that $30,000, but what he can also do is he can borrow $30,000 from the insurance carrier. Why would he do that? Because he's borrowing that money from the insurance carrier and using $30,000 in here as collateral. Okay, so he would borrow at an interest rate of 4%, while his money is growing there 8 to 10% a year. So he will get a spread here in the long term. Now, I know those of you saying, oh no, you shouldn't do this because a year or another year we're going to have a 0%, so we're going to lose money and yada, 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 and it's not advisable that people do this. Now, it's true that some years you can have the market going, or your index plan going at 0%. Let's say the S&P 500 fell 15% and you're zeroed out and you're still paying the 4% on top of that money. That is true, but in the long term, this money is usually going to outperform this 4%. So if you pay that money back slowly, your money's going to outperform that. Okay? Interest is a very interesting thing. Interest, you either pay interest when you grab money from a bank or you borrow money from a lender or something, or you do not make interest when you pay cash. In this case, you are leveraging the money you already have. So this is very interesting for people that are actually real estate investors. Okay, this is a very interesting strategy. Now, keep in mind, if we're putting $300 a month, $500 a month into these policies, we're really only going to have some cash value around year 5 or 6. Whenever we set up infinite banking accounts, then we need to put in money in bigger lump sums. So what we would do is, let's say we have $100,000 in excess cash. We'll put $20,000 for 5 years, and we'll load up the all the money in the first year, so you can have that money in year 3, year 4, and year 5 to use. Okay. So just a recap, infinite banking is a strategy where you borrow money from yourself and you get interest on top of it. But this is only interesting for people that have excess cash. Please do not follow these gurus that say that you should use your money to pay your day-to-day bills with that money. That's not what infinite banking serves its purpose for. All right. Now, you guys may be asking yourselves, okay, this is way too good to be true. You're saying that the carriers are going to give me interest on top of my money. I have a 0% floor. I'm not going to lose money over time. What's the catch? The catch is that there are fees involved with this. So if you give up your money in the first years, if you stop paying into this policy in the first years, you're going to lose a lot of money. You pay a ton of fees for the first 10 years of the policy. After that, your fees drastically lower, and then it becomes very inexpensive. But what happens most of the time, and all the carriers know this, is that people give up on their policies in the first year, and that's how they make money, because they don't give that money back. It's important that you understand that if you're doing a month-to-month basis, in the first year, you're only going to have about 10% of your cash value available to surrender. The second year, about 20%. The third year, about 30%. Up until the 10th year, you'll have 100% of the cash value available. So if you cancel the 10th year forward, then you'll take 100% of your money out. But it's important for you to know that in the first years, you should have no liquidity. Okay, so don't count on that money for the first years. And yes, you will have high fees. Okay, you will have high insurance costs. But this is also a life insurance plan that you will carry for the rest of your life. It's not a term insurance where 99 or 98.5% of people will outlive. Okay, so this is actually a statistic. If you create a 20-year term, there's a 98.5% chance that you're going to outlive this term and not have to use it. This is for life insurance, it's not for living benefits insurance. I don't really know the specs on living benefits, but I would imagine that it's something up in the 90s as well. All right. So in my opinion, an IUL is a great way for you to create cash value. There are other advantages, like it's litigation free. So most of the time, no one can touch that money, right? Like people can foreclose on your property. A bank can foreclose on your property. They can take all your savings from your checking account, your savings account, but they can't touch the money that's in an IUL. So there's that advantage as well. And it's something that you can create generational wealth with. Okay, but it's not for everyone. Okay, it's for people that understand the reason to have it, people that actually have someone that depends on them, and people that need insurance. Okay, just because you do have disability insurance through your company, that does not mean that you're 100% covered. Okay, so this is a big misconception that people think that just because they have disability insurance, they do not need living benefits insurance, and that's not true. Okay, not for everyone, but it is a great plan. I hope that this answered all your questions, how an index universal life plan works, and I hope you like this video. So please subscribe to our channel and like this video and send this to a friend. All right, thank you. I'll see you later.